Good evening, all. A very warm welcome to each one of you. My name is Hariharan, and I head the Learning and Development Department at Axis Mutual Fund. I shall be the host for today's session on Axis Mutual Fund's view on investment philosophy for the year 2023. On that note, let me extend a very happy new year to each one of you. The year 2022 was fraught with a lot of uncertainty. With the COVID pandemic waning, we faced a lot of other new challenges in the form of Russia's war in Ukraine. There was soaring inflation. Then there was the interest rate hikes that happened across. Indian markets, however, showed a lot of resilience. The Sensex scaled a new lifetime high of 63,000 in the month of December. The Indian market went up by just 5% in the entire calendar year, but it was yet the best performer among most key global indices. It was a bad year as far as the foreign flows were concerned. In fact, if we were to look at it, we could actually split it into two halves. The first half saw heavy selling by the foreign institutional investors, and the second half represented a comeback. Net, they sold Indian equities worth about 1.2 lakh crores in the calendar year 22. However, the FPI offload was cushioned by strong buying by the domestic institutional investors. The Indian rupee also fell to record lows in 2022 and depreciated by about 11% in the year. The year 2022 was also the year of crude supply shocks, where we saw that Brent crude rose to a high of almost $128 in the month of March, and then we saw it cooling to come below $80. Overall, Brent crude in the entire year went up by about 9%. As far as the fixed income space was concerned, the year 2022 was also the year when global central bankers went on a rate hike spree. The US Fed raised the interest rates by about 4.25%, followed by most other central banks. RBI also followed suit. They upped the repo rate by about 2.25% to bring the repo at 6.25%. The 10-year GSEC started at about 6.5% in the month of Jan 2022, went to a very high level of 7.6% in June, and then ended the year somewhere about 7.2 to 7.3%. If one were to sum the entire year of 2022, one could say that it was an year of absolute chaos. As investors, most of us have faced headwinds from all corners, whether it was war, commodity, stocks, the threat of recession, interest rate hikes, inflation, and even I think all of us would have also witnessed the Argentina Football World Cup win. I think all of these headwinds were faced by all of us. While Indian equities and fixed income ended the year with modest gains, the rest of the world was a scary place for the investors. We at Axis Mutual Fund believe that the year 2023 could be the phoenix year for Indian investors. To offer a glimpse into the Axis Mutual Fund perspective and to look at how the portfolios are positioned going into this year, we have with us Raghav Iyengar. Raghav is the president and the chief business officer at Axis Mutual Fund, is an industry veteran with more than 25 years of experience. We look forward to hearing from Raghav and make the most of his experience and expertise. At the end of his presentation, we will also take the question and answers. With that, over to you, Raghav.
Hey, Hari. Hi, everyone. Good evening. Just do a quick sound check. Am I audible, Hari?
Yes, you are.
Great. Can you just put that PPD off maybe for 30 seconds? It'll just sort of so that people can figure out whether I put on weight, lost weight. Hi, everyone. Good evening again. On behalf of Axis Mutual Fund, many thanks for joining us on this Friday evening. We'll try and keep this as crisp as possible. We have almost about 1,400 odd registrations, and as I'm speaking to almost about 400 odd people have joined, and hopefully a few more are in queue. Like Hari said, I think this has been an absolutely havoc year. I think since this is the first time since possibly the late 18th century that none of the asset classes actually performed. I mean, there was no place where investors could hide except possibly your bank savings account, right? I think debt funds gave a negative return. And this is globally, this is not India. Debt funds gave a negative return, equity was completely in shambles. We've all seen the collapse of crypto. Gold, which is supposed to be a safe haven, actually didn't do anything at all for the last 9, 10 months. I mean, last 1 month, something's happened. Silver saw some pickup in the month of December, but if you correlate it on a year on year basis, again, nothing happened. It's been an absolutely roller coaster kind of a year, right? And so we have a brief presentation, which I'll quickly run you through. And then maybe we'll just get into a Q&A mode, and hopefully I'll let you go quickly so that you can enjoy the rest of the weekend. So Phoenix is, what is the Phoenix? I think the Phoenix is, if some of you are Harry Potter fans like I was, I think if you remember, there used to be this, I think the fourth or the fifth movie in that series was Harry Potter and the Order of the Phoenix. The Phoenix is a mythical bird, which essentially, when it completely burns off after a point of time, and then it resurrects itself, and obviously the whole cycle goes on again. So I don't know if you remember, this used to be one of the key birds in the Dumbledore set of friends in those days. I mean, for all the Harry Potter friends there. So this is, in some sense, as Hari said, this has been a 2023 was a bit of a phoenix year for us, and I think even the same thing is going to happen in. I'm sorry, 2022 was a phoenix year, and 2023 again is expected to be something like that. So let's just take a quick look at some of the slides that we made for you. Yeah, Hari, next please. So if you look at the year, I think obviously everyone, this is a breakdown of what's happened over the last 40 years in terms of returns, right? And if you look at, there have been very, very few years where Indian markets have actually given you a negative return. And we've largely broken it up -20% and below. The one that comes to mind immediately is obviously 2008 and 2011, 1995, 2000. So all these have been sort of seminal years. We didn't see that happening incidentally in COVID, because if you remember, in COVID, the market collapsed in the month of February, March, but in April, May, June, July, if you were to look at a January to December calendar year 2020, actually the market did reasonably all right. But if you see, look at the other years, I mean, 2000 was Y2K, 2008 was global financial crisis, 1995 was actually our whole capital market issues that we had, and 2011 was again a bit of the Indian financial crisis in those days. -20 to 0 again, and I'm going backwards because I think to invest in equities, one needs to be a bit optimistic, and this chart actually explains why we are quite optimistic on the Indian space. So if you look at again -20 to 0, 1998 was again the Pokhran nuclear blast where we faced some serious sanctions. 2001 again outshoot of the 2001 Y2K issues. 2015 was again a bit of a crazy year again because it was again just after a spectacular year which happened in 2013-14, and of course 1986 was again a big turn in the capital markets in those days. So obviously the majority of the years are in the 0 to 20 space, and there have been a lot of years in the 50% and above, right? Interestingly, last year, unlike in 2021, we saw mid caps and small caps actually not doing too well, and that typically follows a bit of a reversion to mean. If you see, anyone who invested in 2020 21 in mid caps and small caps made a huge amount of money. Obviously that market, I don't think the corporates were able to deliver up to expectations at that time, and there was a bit of rotation back again into the top nifty companies again. Yeah. Next please. So heavy year on news flow. I think started off with the economic survey, budget was good, and then suddenly, obviously, out of the blue, you had a Ukraine-Russia war, the first time a war being fought on the European continent since World War II, which is 1945. And everyone, including most fund managers across the world, really expected that to be like a quick shooting match, maybe 1 week, 10 days at best, when then everybody will get back and peace talks will start. It's now almost a year, in fact, exactly 11 months as I'm speaking to you today, and just about another 25 days more, you will find it gets into we are going to have the first anniversary of the Ukraine war, and again, unfortunately, no signs of it abating. In fact, if not anything else, at least things are actually going haywire. What happened because of that? I think obviously inflation spike. And Ukraine is very, very interesting country. I mean, apart from obviously the oil price shock, which everybody felt because of the sanctions on Russian oil, many people don't know that Ukraine is possibly one of the largest grain suppliers to the world. So wheat, sunflower seeds. We import a lot of sunflower seeds, by the way, in India from the Ukraine. All that went for a complete six because the action and the war was actually happening on the port side, where most of the exports happen on the Black Sea side. And obviously, thanks to the war, that whole area got cordoned off. Obviously, no ships were coming in, blockades, etc., etc. So the whole thing, and we are so tightly knit today, and that's the challenge in the world economy, that there is really no bench strength. There is no leeway for anything. We are all on what we call just in time kind of world. So even if there's a small disruption somewhere, it tends to sort of put shockwaves across. And then obviously you had a whole series of Fed hikes across the year. Not only Fed, I mean, the Fed was the one who started it off in November 21 last year, and then it just continued. I mean, it's 25.50, 25.50, and today we are at an unprecedented level again. And obviously Fed, uh, which essentially controls the dollar, which is the reserve country currency of the world, that obviously led to all large economies, including India, actually raising rates, right? So it's been a bit of a complete inflation warrior phase, and I think if we look at the markets, just went absolutely up and down. It's been an extremely choppy year. But having said that, yes, I think India was one of the few markets that actually gave a positive return. In dollar terms, we were negative. So obviously, FIs didn't have a great year. But yes, compared to the kind of losses that they made in other markets, I think India is a bit of a beacon of sunlight in an otherwise very, very dark world there. Next, please. Actually, the FI sell-off was very good news for us. If you look at 2018, we did lose some money, but look at the amount of money they withdrew overall, minus 58 billion, right? 2019, actually, India was positive, almost 80%, 70% of all FI money, emerging markets came in. We tried to put in some of the largest markets which take into FIs, obviously excluding China, because China is in some sense a very different market altogether. Look at 2021, actually, if emerging market funds were actually minus 33 billion, 34 billion, and India was plus 3.9 billion, right? So 22 in some sense has been a bit of a reversal of that. Obviously, FI has continued selling across the emerging market space. That's largely in line with a very, very strong US dollar, higher interest rates, pulled money out of emerging markets typically, because I think when you have a lot of uncertainty, the safest place to be in is in the US dollar, your own home currency, and obviously in fixed income. Rates have really taken off, especially in the last 6-7 months. So India lost a fair amount of money. And like Hari said, I think, at one point of time, we were almost about 15, 16, 45, 50,000 crores of negative outflow for the year. But of course, the last 3-4 months, I think some buying emerged. It's back. As we're speaking to you, that sell-off continues. I think as of now, year to date, I think from Jan 1 to whatever was till yesterday, we will be about minus 15 or 1,000 crores of negative flows even today. So that outflow even today continues. One reason we'll talk about that maybe in another 10-15 minutes, why that's happening. Next, please, sir. So what we're seeing is a bit of a global reallocation of global assets, right? So I think typically, I think if you ask me, a lot of money which was safe haven in for India, for example, typically would have been technology, maybe FMCG. Those are the places which had the maximum amount of outflow, and we are seeing obviously some reallocation towards utilities, towards commodities, towards capital goods, whatever is available. So that's been largely the bit of a flip that has happened in the last 12-13 months, right? Typically, because that's not an India phenomenon, that's happened globally. If you look at the way the Nasdaq has been over the last, if you take calendar year 2022, down almost minus 30%. So basically, a big sector rotation away from technology, away from uh, consumables, away from fast-moving FMCGs, and some big rotation back into core sectors like energy, utilities, and stuff like that. So I think, but the good thing is that people say they've sold more over 20 billion, but even today, almost they're yet the largest component of ownership, non-promoters in the Nifty 500 is RFIs even today. So even today it's a very, very large and dominant block. So obviously when there is consistent selling like what is happening in the last 15 days, market will take some time to find its feet, right? Which is what is happening right now. Next, please. Hari. So I think brief snapshot on what has happened. Largely there are two big styles of investment. I mean, you have obviously the market caps, which is one way, which is your large cap, which is typically the top 100 companies. You have the mid cap, which is 101 to 250, and then of course you have the small cap, which is 251 to 500. Within that, you have something called quality and value. Quality and growth are typically one style of investment, and of course, value, as the name contains, is a value style, right? So, quality typically looks for quality and growth look for high with look for companies with very good corporate governance, very strong cash flow, and obviously reasonably high levels of growth, especially relative to the economy, relative to their peers, right? Value, of course, is a very interesting play. Basically, that looks at cheap, undervalued companies and whether those companies are doing something which will unlock something and then obviously make their prices do better. Over the last, now this is a decade of data. So I think if you look at it since March 20, which is typically when COVID shock got over and markets started recovering a bit, quality is up 52%. Value is up almost 70%. So that's a big gap. You will feel, hey, that means so that's in some sense what has happened. Not only in India, it's happened across the world. Like I said, a lot of those stocks which were quality, high growth, were typically FMCG, infotech, uh, innovation-led companies, and that whole pool of money actually shifted out to more old economy kind of sectors. But if you look at over a 10-year period, even now, despite the last couple of years of value beating quality, you will yet see that quality yet has a 5% outperformance, and that's very large. I mean, a 5% over a 10-year period is significant over value, and that's what's happening today. So we will talk a bit towards the end as to where we think what will happen, but this is a bit of a snapshot of the past. So let me just finish that a little faster. Yeah, Hari. So yes, people, most of us keep reading in the newspapers at CNBC and all the other channels that India is an expensive market. Frankly, it's not. I mean, if you look at the data, our forward P, which is nothing but the price earnings of the index, is about roughly 23 times, and the 10-year average, which takes into account all the economic events, is about 21 and a half times. So it's just about one and a half times higher, 1.5% higher. And if you look at 22 also, it's not like really bad. India was 14 odd times. Emerging markets was about 13 times, and the premium was just about 1.5%. So when I hear this story that India is an expensive market and there are a lot of countries that are available much cheaper, I think the data doesn't suggest that. So there are certain selected stocks, obviously, which look very expensive today because of past earning downgrades, etc., but as a market we are pretty much all right. What do we look at in equities? I think obviously people, most investors have a slightly negative view. We don't. We have a neutral view. Not for anything else. I think India is a growth market. We don't see the markets giving spectacular returns over the next 12 13 months. I mean, I'll be pleasantly surprised if we get into that 20 plus return bucket that we showed you in the first couple of slides. But that doesn't mean that you need to negate equities at this stage. I think you need to make sure that you're pretty much neutral right now, right? I think with the key thing is that over the last couple of years, there was a huge amount of liquidity, right? All of us know we were personally much more liquid than what we used to be. I think thanks to COVID, a lot of us have worked from home. That cut off our transportation costs, that cut off our entertainment costs, that cut off our regular purchases, no holidays, everything else. Yes, there was a bit of revenge buying that's happened in the last 6 7 months, very evident, especially in the holiday season of the last, of the last 2 3 months. If you go to any airport, any railway station, any flight, hotel, things are full. But just go back a year and a half back, and you will just it was a complete reversal, right? So I think in some sense there will be now. I think in some sense the liquidity is getting eased off. I think most central banks are now focusing on removing the liquidity because I think there is now an inflation war happening across the world, right? And central banks will use all the weapons in their disposal, which is raising interest rates, sucking out liquidity, imposing higher premiums, and now will be an interesting phase to see which companies actually are able to weather this liquidity pullout, because when liquidity is there, all boats tend to rise, right? The old famous saying of Warren Buffett, it's only when the tide goes out that you really realize who's swimming naked, right? So I think that period is now coming. I think, and maybe is already here as far as India is concerned. So within very clearly, people who are able to weather the storm, who can show 3 5 year earnings potential, who have very strong free cash flows, have a moat as far as their products are concerned, and are more importantly are able to pass on uh, raw material increase price in the due to inflation back to customers, I think that those are the companies that, in our opinion, will actually be able to weather this storm out and maybe do much better than the broad market today. Yep. Next, please. So I think that was a past. Sorry, I took 5 minutes longer than I wanted to do that. But yeah, let's just look ahead. Hari, yeah. I think very clearly the big event for 2023 is going to be the budget, because this is going to be the last formal budget for this government, because the next year 2024 is an election year, as you all know. So it's going to be a bit of a vote on account. I think the great thing is that budget of 2022, in some sense, was a very realistic budget. There were a lot of off-balance sheet items, NHAI loans, loans like the National Infrastructure Development Fund. Those loans were off-balance sheet, and they all were put into balance sheet, right? And we've had a spectacular year in this year in terms of the GST collection. I think the budgeted numbers, we are about almost 30% higher. I think the good thing which is going to happen is that I think over here, I think subsidy spending is going to be a big focus of this government, because there are sections of the population which even today are finding it difficult post-COVID, right? And number two, of course, this whole China plus one uh, opportunity that we have, because I think the world realized in 21 specifically, and now parts of 22, that how much of disruption can happen to their economies if they are over dependent on a country. And China has some phenomenal infrastructure, phenomenal factories. Even today, 35% of all chips made in the world are made there. But many corporates now are thinking about, especially large MNCs are actually thinking about how to move away, or actually sort of de-risk over concentration in China. So yes, I think we won't get all of it, but even if we get a bit of it, like I think over the last 6-8 months, I think most Apple phones that we now buy are actually being manufactured in India, right outside Chennai. There's a Foxconn plant there, and it actually gets made and sent there. So that's a couple of $1 billion of phones which we used to import earlier, that's now being made locally here, right? So I think the PLI scheme, which is production linked incentive scheme, will get further impetus. And I think more importantly, I think the government, this government has been very fiscally prudent. Last 2 years, obviously, they had to open the taps, but they didn't do much compared to the rest of the world. And in some sense, that's the reason why India is in a much more fiscally better place as compared to some of our neighbors, more importantly, and even some of the G20s that we are hosting this year. So I think that's, if you see tax revenue as a percentage of GDP is going up. Fiscal deficit obviously did go up because of COVID. Obviously, government had to spend. I think there was a life and death situation. At that point of time, you don't worry about deficits, you don't worry about ratios, you worry about the people. But I think now, given what's happened, especially in the last 12 months, with things slowly coming back to normal in the first 6 months, and the last 6 months really roaring back to normal, especially on the consumption side, I think you will find this budget will be very interesting from a consolidation perspective. Yeah. Next, please, sir. So commodities is today our biggest problem. I think if I have a slide in the end, which is the risks to this whole case that we are going to build out. But fortunately for us, I think we did see an oil price shock. It went all the way from $60-70 in 2021 all the way up to 110, 120 almost, and then luckily came back down. Now, thanks to the fact that we are buying Russian crude, I think the crude basket is getting beautifully managed. So I think that's the big one for us. I think because unfortunately, even after 75 years of independence, we are yet importing about 80%, 85% of our oil. And that's a really big negative for a country as big as India. And our biggest competitor again in the oil space is China, which is another massive, large oil importing country, right? So I think when two of the most populous nations are the biggest buyers, I think that tends to create some stress, especially if there are supply shocks like what happened post-Ukraine. But fortunately for us, I think commodities have really cooled off. Agri commodities have come down. Metals have come off quite a bit. Some commodities are yet obviously trading a bit higher, but fortunately, compared to what the prognosis was in June 2022, when 3 months of the Ukraine crisis had passed and it didn't look like it was getting close, the worry was that, hey, if oil goes to $140, you will have a serious problem. India will then have serious growth issues. So far, that's good. I think gods have blessed us, so we are reasonably in a good place there. Yeah. Next, please. Hari. So our balance sheet, both sides is heavy. I think that's the good thing. I think last 2 3 years, courtesy the amount of liquidity, demand acceleration, I think most of the leverage has actually dropped significantly. So it's come off from a 62% to a 45 47%. NPAs, which is non-performing loans, have really dropped significantly. I think there's a lot of recovery that's happened there, and more importantly, even the per capita leverage. I think on the individual side, which is a worry for all of us, especially during COVID, has also remained quite healthy. Most of this leverage on the individual, of course, is towards housing, which is a good asset to own because it's very secure. So I think from a banking sector, I think that's one of the reasons why the banks are looking very, very good today. I think you have a great NPA recovery cycle. You have new credit growth happening both on the retail side as well as on the institutional side. Corporate India has been on a deleveraging space. They've not really added too much. Private capex has not been as great as it was expected to be 2 years back. But right now, today, we are seeing some green shoots in that. And I'll talk about that in the next couple of slides. Next, please. So today, what's our portfolio going to do? I think that's important from all of you because I think so far it was all general stuff and a lot of that could automatically be read or even watched on a YouTube. I think very importantly, we are going to play two big themes. I think obviously consumption, which is the rural recovery. I think that's a great place to be in because I think we've had a couple of very good crops, especially the winter crop has been very, very good. I think post budget, one very, very common theme which we expect is a lot of support for the rural economy, both directly and indirectly. And obviously, I think very, very clearly you're seeing some very, very good green shoots on the rural employment side, which had gone into a bit of grim territory in 2020 during the COVID period. On the capex cycle, yes, I think the public capex cycle has improved. Obviously, certain sectors you can see it very, very obviously defense, roads, etc. But I think more importantly, I think the PLI has actually given private capex a big boost, and I think that's in some sense that was the missing link because government has been pushing for private capex for the last 3 4 years. The government has done most of the heavy lifting on capital expenditure, but I think we need private expenditure to come back to be able to sort of the one plus one makes it actually three there. Right? So I think there are some interesting capex opportunities available there. Credit growth is there. The first one, obviously, we will buy through FMCGs. I think you will see a fair amount of our portfolios yet running yet in fairly invested in stocks which are focused across consumption, and which typically have a much bigger footprint in rural and semi-rural India. On the capex and credit growth side, obviously banks remain a favorite sector of ours. I think especially banks you can use to even play the capex cycle because they are big beneficiaries of the whole loan revival, and obviously in terms of the NPAs coming down a lot, and obviously retail credit growth has been obviously very, very strong today. Yeah. Next, please. So I think this is, I think as I had pointed out, if you look at the Feb 20 slide, which just actually crashed, you saw that was the COVID period. That was a terrible period for us, especially across rural consumption. And I think more importantly, urban consumption got things back. But over here, the biggest risk is urban poverty. The biggest challenge today for India is not rural poverty, it's actually urban poverty because a lot of people who live in our large metros today are finding it very, very difficult to sort of make ends meet. And I'm really hoping that the government does something for that section of society because we do a lot of things for rural, we do a lot of things for semi-rural, but the urban poor are typically neglected. One thing which is very clearly happening is housing is a big focus area, especially subsidized housing. We hope that will actually reduce some of the urban pain which is now being experienced, right? But the good news is that even today about 70% of the country, 67% to be precise, lives in rural India, and that economy is doing well. So anything to do with that in terms of consumption, in terms of investment, those are interesting companies to look at. Yeah. Hari, next. Capex is something that we've had a lot of false starts, especially over the last 5 6 years. I think it picked up in 2012-13, and then it just crashed and the taper tantrum, and then it went all the way down. We had the 2017-18 GST issue. We had 18. We had the ILFS credit issue, and it really looked like the whole capex cycle was actually completely stalled. And to get an economy back up, you have to get manufacturing there. We are a very, very large service-driven economy. That part of life is very good, but if you really need to create a lot of jobs, and if India really has to get to that $5 trillion mark in terms of GDP, I think a huge amount of manufacturing investment is required. In the last 5 years, it's largely been done by the government in all its formats, state, central, and local. But over the last, especially over the last 1 year, we are starting to see private capex also start coming back, right? And especially in basic industries, airports, ports, cement, you're seeing a lot of activity happening there, right? And that's largely because of that small number on the left hand side, that your capacity utilization is now at 70% plus. Typically, anything over 70 over a sustained period of time will cause capex plans to get out of its cupboards, out of the computers, get dusted, get redone, and then come back again. Yes, I think interest rates have gone up, which is a bit of a risk to this whole thesis. But the fact is that today, given our notional GDP should be anything about 12%, and a good corporate should do about 2-3% more, there is enough cushion to handle the increased rates of borrowing, which will be required to do this capex. So I think the good thing is that yes, impaired loans are very less. I think balance sheets, as I said, are very delevered. In fact, there is a huge amount of ability to take on fresh debt, which I think the banks can fund today. Next, please. So yeah, this is what I talked about. I think the last 5 years have been largely on the back of government, which is as represented by central, state government, and obviously general government PSUs. I think PSUs have dropped off a bit, but it's largely state government has picked up a fair amount. And this is where the good news for all of us as investors is that state governments are now internally competing with each other. So, and really competing. So, you know, uh, Airbus going to Gujarat is a front page economic news item, right? Which is now seen to be that what did Maharashtra do wrong that Gujarat did right, that money went or the investment went from here. Or if there's a large plant which was supposed to be set up by Apple and it's gone to AP Telangana. So what did Karnataka do wrong that money didn't go there, right? So that's good because in the past we've never had those internal competitions. It's the state governments have largely behaved in a regime of their own. I think they have now realized that the Indian voter, especially after 75 years of experience, has become far more conscious of who's doing work and who's not doing work. And one barometer of that is what new jobs are being created, what new infrastructure is being created. So you will see state government has really picked up a lot. Central government obviously has also picked up a lot of slack, and especially now with budgetary numbers being much better than anticipated, we expect this to continue into 23 too. Yeah. Next, please. So good thing is private has now started showing some green shoots. Of course, it's very early days, so I won't thump the table and say wow we are here. But I think in compared to 2014-15 when there was a great expectation, especially after the BJP government got sworn in, that there'll be a big move on capex, and obviously that didn't happen because capacity utilization was not yet very high in those days. Today I think that number is now completely changed. I think today you're back to, as I said, 77-78% capacity utilization. Many sectors there is just no fresh capacity which has been added for more than a decade. So that is now coming back to haunt many of the factories. Also, the fact that I think there is a very strong China plus one strategy is also looking at global investors are also looking to come here, right? And obviously, we've seen that now in a few big industries where there is a lot of internal demand, mobile phones being one, consumer durables being the other, and anything in and around that is great. And also, there's a huge focus on infrastructure, right? I think if you go out and we look at it, the golden quadrilateral, the border roads. Roads are such a big story today, and that what does that do? That just improves logistics, that improves connectivity, that improves people movement, goods movement. Ports, I think if you look at the kind of new ports that have got added in the last 10 years, look at river movements, lots of work that's happened. Unfortunately, we don't tend to see it because we're all living our lives getting stuck in urban traffic. Yesterday in Bombay, finally two large metro lines got inaugurated. So hopefully that will decongest a lot of things. And the fact is that we are yet a young population. So any infrastructure of any scale getting created will automatically get fully utilized. Somebody told me that when the Bangalore Metro got opened 3 years back, I think they went into sort of 100% ridership in like 3 months. I mean, and what was expected to take 2 years actually happened in 60 days. So that's the kind of pent up demand that there is for infrastructure. And those are the kind of companies that are coming in. I mean, I'm sure you guys have read about the order, Siemens getting a 16,000 crore locomotive order, which will essentially run on hydrogen, for example. So a lot of new technology, new international collaboration, and obviously a lot of, and that is being fueled by the fact that there is a huge requirement for infra internally. Next, please. So corporate earnings, yes, last 12 months have been very good. I think that's largely on the back of 2021 being pretty bad. So we've had, as Hari rightly mentioned in the beginning of the conversation, we've had a bit of a tale of two halves, right? I think the first 3 6 months of the year of 22 was a period where people are very nervous because you did have COVID all the way till March, April. I mean, it was Omicron, so it was fortunately not a fatal thing, but it did create a lot of disruption. I think come June, July, when the economy really firmly opened up, is when actually earnings started really picking up. And now again, we are a great place to be in. India is a bit of a bright spot in a gloomy world. But having said that, we cannot be delinked from the rest of the world. So what will happen internationally will affect us. So if people tell us very often that, hey, you guys are lucky, you're in this great island of tranquility. And I say that's complete nonsense because eventually it does. Like, let's look at IT as an example, right? IT was one sector where Axis was very, very bullish. In fact, one of the reasons of our underperformance in the last, especially last 6 to 12 months, has been our overweight stance on IT. What happened? I think there was a recession. Uh, our investment thesis was that IT will actually do well in a recession, but unfortunately, what gets cut off in a recession is non-critical stuff, right? And eventually, yes, a shallow recession will bring a lot of the order book back, and some of the large frontline companies whose earnings have come out have done pretty well compared to street expectations. But yes, it did take a toll. Now imagine that you're in an IT company, you're working there. Last 2 years, you got an increment of 14-15%. This year, there's a good possibility you won't get that at all, right? What does that do to you? I mean, in the sense, you will obviously cut your consumption, you will cut some spending, you will cut some investment, and that cycle then tends to reverse itself out. So I think very importantly, today is not it's not going to be a big bang year. You will have a lot of companies which will sort of uh, underperform this year because when the revisions happen, the weaker companies get stuck because unfortunately they're not able to pass on price hikes to customers because then there's demand destruction. If they don't pass on the price hike, then that leads to a profit destruction, both of which are extremely bad for for their stock prices, right? So one needs to be very, very careful. This is a period where one needs, it's really, you have to really pick the diamonds in the rough. There are 2021, you could actually play any mini minimo, pick up any stock, and there's a very good chance that that stock would be up 20-25%. I think in 23, one needs to be very, very careful about stock picking, especially over the next 3 to 6 months till we get a sense as to where the international recession is going to go. Next, please. So this is where I think quality is at, we call it the quad investing. I think this is a very, very good investment theme that we would like to talk about. I think the quality basket, which is a basket of some of the highest, best quality indexes that are available, was expensive in 2020. If you remember, there was a point of time where out of the 3,000 odd actively, 2,000 odd actively listed companies in the market, just 25-30 were running. That was that 2020 period, just after ILFS. And then now, in that sense, so you saw valuations actually going up. And now look where we are today. We are way below the average mean over here. So actually, we call it quad, which is quality at a discount. These are great companies. Their earnings have actually done much better in the last 3 years, but the price hasn't moved. So actually, their P ratios of many of our portfolios are actually at possibly multi-year lows today. That's largely because the price has largely been constant, and but unfortunately, the market hasn't taken the good thing is that the earnings have gone up, the profits have gone up, but the prices have gone nowhere because there has been a move, as I said, into value, into momentum, and into other stock and sector flavors. As the world gets a little more complicated, as recession comes more into view, as people start getting a bit more conscious about the kind of companies that they're holding, we expect that this whole quality basket will start coming back into flavor again, because essentially these are companies where you have pretty clear visibility of earnings, you have pretty clear visibility of cash flows, and you have a very strong management and product basket, which will hopefully tide over whatever storm is coming over the next 6, 12, 18 months. Right. Next, please. Hari. So, in summary, I think we are an island of calm, but yeah, one shouldn't get overconfident about it. I think we need to be very, very careful. What are we looking at? I think we're looking about 70-80% of our portfolio will largely be invested in domestics, which will be able to hopefully uh, be able to avoid the global headwinds, and about 20% will yet be in sectors which are external facing because uh, of the one reason I told you, which is oil, right? If oil suddenly goes back to 140, 150, which is something one very difficult to predict because oil is now it's not a supply demand issue, it's actually more of a geopolitical issue. So our portfolios largely have the corporate earnings in our portfolios have been very, very, very strong, including some parts of the IT pack, which disappointed us in the later part of 22, but has come back with a bit of a vengeance, right? I think very, very important to minimize beta. Beta is element of risk that you're taking. I think it's very critical over the next 12 to 18 months not to be in very high beta stocks because even in a small disappointment in earnings can lead to a really big crash in price, right? So markets at an all-time high also means that there is valuation risk in many, many sectors. It's not a cheap market anymore, unlike 2020 February or March. Can it happen? Of course. I think it's very important to keep your powder dry uh, or invest in a very, very disciplined manner. So for me, I think on a personal basis, I look at asset allocation. I have a certain amount of money in equity. My equity investments are largely in two big styles, which is value and growth. Obviously, growth is with Axis, value is with somebody else. And hopefully, over a period of time till 2020, growth was really the rocking part of my portfolio. Value was depressing. In the last 2 years, that's flipped, but that's okay because I'm a long-term investor. So, but I think the next section for the next 5 minutes, I'm just going to talk of fixed income because that's another really big part of the market that we've actually forgotten about, right? Yeah, bond markets. Yeah, next please. Yeah. So yeah, again, as I mentioned in the beginning, this has been a very bit of a weird year because Indian bond markets have at least been positive. I think global markets, if you especially look at the UK, look at the US, maybe look at Japan, you had a situation where normally when equities do well, bonds do all right, and vice versa. This is the first time that everything did badly. So there was no asset class which was sort of temporarily was unaffected. I think the only asset which really did well was the entire dollar index, but you and I can't buy that, right? At best, even foreign stocks didn't do well. Nothing actually in the whole portfolio. Everything looked quite bleak. So in that context, an Indian bond market giving you about 3.5% return is not bad, basically. So, but where do we go from here? I think that's important. Next, please. It's been a bit of inflation here. As I said, if you go back and see 2021, people were more worried about getting the economy back in shape after COVID. People were having a lot of false starts, economy opening, COVID coming back, again closing. So it was more of that. But 2022 has been really a bit of inflation. Now, let's go back and see what happened to inflation. I think obviously one was this whole shutdown of China, really created a mess for goods supply. Second thing was obviously Ukraine, which actually really created a lot of issues on the agriculture side. So between these two issues, you had China shut down, you had a big problem as far as manufacturing components, everything getting into trouble. And on Ukraine, you had the entire mess in terms of agriculture. And in the middle was obviously the whole Middle East issue because obviously they're torn in between both. So you had a crazy year where everything, all commodity prices, agricultural prices, all input costs essentially went haywire. And you had a period where, thanks to the fact that people had more money in their pocket, I think you had a massive demand spike also. So all that actually came into fore in 2022, and inflation suddenly became the big like the war against COVID in 2020 and 21. Actually, 22 was in some sense the war against inflation. Next, please. So one big thing which happened was, I think if you remember about a year and a half back, we spoke about this, that almost 30% of worldwide central bank debt is actually was giving you negative returns. That's all completely gone. I think there is nothing that gives you negative debt except maybe a little bit of Japan, who's an outlier here. But if you look at the US, you look at Germany, Germany 10-year bonds used to be -2%. Bank of England bonds used to be practically nil. Everything is up. So it's been like a end of an era. And obviously, the good thing is that it's great for savers like us because till 2, 3 years back, we were not making any returns. In fact, we were making negative returns on our savings. But fortunately, right now, given where rates are, I think there's a lot of opportunity available now to earn a decent return even on fixed income. Next, please. One reason why rates went haywire was obviously most governments, most including the RBI, actually created a lot of liquidity in the system. So if you see uh, every scheme, every mutual fund, all debt, whether it was double A, triple A, everything actually rates came down to an abysmal level. I mean, you had now 3-year government corporate bonds at like 5.25%, which is actually giving you worse returns as compared to inflation. But in today, systemic liquidity is actually neutral, which means that it's not excessive, is not here. In fact, neutral liquidity is something that the market is yet getting used to. Market over the last 3-4 years has always been focused on getting a very high level of liquidity, but that's gone now. So you're seeing the impact of that. Next, please, Hari. So RBI very clearly is also part of the inflation targeting war. You can't be different. I mean, we've also had unlike the Western world, we've always had this inflation issue. For us, obviously, it just went up a little more. So in the Western world, it actually went almost from 1% to 6%, was like 5 times. So people I know in Europe, for example, saw their power bill go up 3 times. I mean, that we are used to it going up, but so in that sense, we are easier. We have to be synchronized a bit globally, otherwise the entire forex issue becomes a bit critical. And obviously if you take rates up too fast, too quickly, too much, then I think that tends to paralyze growth. So I think RBI is largely focused on these three things. Inflation is obviously the big fight. They need to anchor it at a level which is manageable, which so far has been in the 5 to 6%. They have to be at the same time synchronized with what's happening in the world, especially with what's happening with the US Fed. And lastly, of course, we have to play our own game here in India to make sure that rates don't go so much that you completely uh, kill off the capex cycle, which is just in its initial phase today. Yeah. Next, please. So today, I think really markets across the curve. I think short-term funds, 6-month bank CDs have just gone haywire, just up by about almost 2.5% in the last 1 year, right? And that's visible across some of the YTMs in our funds, which used to be like in 5% levels, is now close to 7.5%. Duration did see a bit of a spike, 6.5, 670 became 740, 750, but has been then very well behaved after that. So I think the interesting thing is that the market believes that you will possibly get maybe some more rate action happening in the next maybe 3-6 months. But if you take a slightly longer view, maybe 4-5 year, 10-year view, broadly whatever has had to happen has happened. Right. Next, please. So this is the beauty part. I think the yield curve is flat, which is not a good thing from an economic perspective, but a great thing from an investor perspective. So if you want to be the best place is what we call the belly of the curve, which is in the 2.5 to 3.5 year segment. You're getting a pretty good carry. Many of our funds, like the banking PSU fund or some of the target maturity funds that we've launched, are all having YTMs as of December 31st, as though the fact sheet over 7%. And that's an interesting place where one can look at for investments, right? And obviously the important thing is, please make sure that your investment horizon is higher than the duration of the fund. We've seen many investors have negative experiences because their money was for 3 months, but they went and put money into a product which actually invests in a tenure much longer than that. And this is not the time to be taking interest rate bets, given the environment that we're in. So that's the only caveat I have for you. Next, please, sorry. There is very decent opportunity in credit. I think given what's happened to Indian balance sheets, we've spoken about it. Massive amount of leveraging has happened. I think even A-rated bonds, AA-rated bonds are giving good value today. But again, one needs to be careful here because rating is just one important criteria by which one should select an investment. There are a lot of other criteria that happen. But yes, credits are a far better place today than what they were maybe 4 or 5 years back. Next slide. So we've been somewhat adding duration. As you can see, the whole of 21, we actually played our get debt funds were very, very short in duration. About 85-90% was in less than 1 year assets, and about 10% was more than 5 year assets. That thing has now flipped. Like we said there is enough value between the 2 and the 4 year segment, and that's where large parts of our portfolios are being managed. Because I think our job is to try and give you the optimum the mix of risk and return, and obviously that the 2 to 4 year segment is an interesting place for that to happen. Next, please. So the last slide, of course, on risk to investment. I'm sorry, I know I've run way beyond. I was supposed to finish this by 4:45, but it's been a very, very heavy presentation, and I'm thank you very much for bearing with me. But yeah, the biggest risk for me as a fund house or is this whole crude above 140. Geopolitical tensions will affect all of us. Not it's not just not going to be an India problem, but crude above 140 is very much an India problem. So I think that's the big one that I'll worry about. Rupee depreciation has been. I mean, we did have one bout of devaluation, if I may call it. 76 became 82, 83. So far, it's been stable. Uh, you need to have rupee depreciating a little bit to make our exports competitive, but it shouldn't depreciate so much that we, along with crude, which sort of we import inflation, which creates its own set of values, right? And of course, I think very, very important. We have to. One needs to keep their powder dry both in equity and debt, because when you get a strong credit like a credit demand like we are seeing today, I think the chances of somebody issuing bonds at a higher level is very, very high. So many people have this theory that hey, it's 7.5%, we should go all in. I think this is a year where you need to keep some liquidity with you. You need to take it gradually. Equities can be neutral. Of course, if there is something that happens, some temporary issue around the budget or something happens internationally where you feel where rates come off, or maybe FIs come in and sell again big time like they sold in the second half of 2022. I think those are great periods for you to put some money into equity. But otherwise, just please be in a very, very systematic manner. Continue your SIPs. If you are underweight in equity, is a good time to start building something through a systemic withdrawal plan by which you withdraw money from debt and put it into equity. Sorry, a systematic transfer plan where you withdraw money from debt and throw that into equity over a period of time. Don't get carried away by news. I think there will be some shocking headlines that will keep coming, both on the private market side and on the public market side. Don't worry about it. As long as you have kept your asset allocation constant, you have a mix across styles, across caps. I think as an investor, you'll be fine. Thank you so much for being a patient audience. Yeah, Hari, I think we had some questions, right? If you want to spend the next 10, 15 minutes just finishing that off, I hope that's okay. Siddharth?
Yes, I think thanks very much for the detailed presentation. Let me take a few questions, that have come up on the link. You talked about the fact that fixed income is something that people typically don't talk about, and therefore the first question is on the fact that RBI has raised the repo rates. There has been a raise, and as you also mentioned in one of your slides, that the most of the instruments have sort of seen a spike in the interest rate. So given this fact, is a debt mutual fund a better alternate as compared to a traditional instrument in the current context?
Given the fact that I work for a mutual fund, I will always say yes. But there are three things that I think you should keep in mind. One is, see, a debt mutual fund largely has one big advantage, that it is redeemable at any point of time, right? With like a 24-hour notice, you give me the redemption today by 3 o'clock. The next one working day, we will put that money back into your account. So it gives you a level of flexibility. Number two, for me, most importantly, it allows you to sort of pay your taxes when you get out of the fund for the amount that you get off. So in some sense, let's say I have 5 lakh rupees invested in a debt fund, 5 becomes 6, I take out 50,000. I will pay tax proportionate to the amount of the 50,000 that I've taken out, which doesn't apply in other instruments. So taxation is a big issue. Liquidity is a big issue. Number three, I think, as I said, the absolute returns, given where we are today, that the yield curve is quite flat. Anything in the 2 to 4 year bucket is a great place for someone to come into. But yes, if someone is in the low tax bracket, can afford to lock money away for 3-4 years, gets a very good AAA bond or a very good FD from a good reputed bank, maybe Axis Bank kind of bank, I think it's also a good place to go and look at FDs also at this point of time. I mean, if you go back just a year back, I think the same banks were issuing FDs at maybe 2 to 3% lower. So it's a nice time to look at it. Having said that, I don't know where rates, as I said, rates could be very choppy during the year. Obviously, if you invest before March 31st, there is an element of an additional indexation that you get, which reduces the amount of tax that you pay. So that's the thing for debt funds. For any other debt instrument, Hari, you can go through the year.
Sure. A lot of questions pertaining to the performance of Axis schemes. So I'm sort of going to mix all of them and ask one question.
Yep.
People are saying that investors have said that we have already invested in a lot of your equity schemes,
Yep.
and over the last 1 to 2 years, we have seen that the performance has not been up to the mark. Whether
Absolutely.
growth ops, focus 25, blue chip. So could you sort of give us the reasons for the underperformance? And the additional question to this is, what kind of changes have you done as a fund house to sort of overcome this shortcoming? And
Okay.
by what time do you expect this to sort of start rewarding investors?
That's a good set of questions. And yes, I think it's, first of all, my apologies. I think it's important for us to accept that there is a problem with our fund performance. I think the fact is that the last 2 years have, especially 21 and 22 calendar years, have not been kind to our portfolios. Uh, I experience it personally because, one, as I said, large parts of my money, more than 50% of my personal investments are with Axis. And number two, as a senior employee of Axis, I do what is called the skin in the game. So 20% of my net take home salary by default gets invested into Axis schemes, and that money is locked in for 3 years. That's a great rule brought in by the regulator, I think about 12, 13 months back. And that really, we call it the skin in the game, which is we put our own money in our own schemes, right? Number three, I think a lot of the sponsor money, which is our shareholder money, also has now got the amount of investment that used to be in schemes has actually gone up tremendously. That's also a regulator requirement. So, in some sense, yes, we, as an investor, as an employee, and also as a key stakeholder in Axis, yes, I'm conscious of the underperformance. So that's number one. Number two, what happened? I think very clearly, if you remember the slide that I showed you, I think somewhere in the middle of the presentation, Axis follows something called a growth with quality style, right? And that style did extremely well for the 3 4 year period 2017 to 20. I think there were points of time where it was practically the entire industry on one side and Axis schemes on the other side. That was as recent as maybe 2 years back. What COVID did was that it brought in a huge amount of liquidity, both personally and in the public domain. And all stocks in all sectors started to go up, irrespective of whether they were quality stocks, momentum stocks. It just sort of took off. So I think in that space, we do tend to underperform. In previous occasions where the markets have been not very conscious about ratios, not very conscious about the quality of companies, not very conscious about the quality of earnings, and it's just a push based on liquidity. Access schemes have had an equally bad time. Like 2016-17 was a phase, 2012-13 was a phase. But the good thing is all of that has recovered back very, very strongly. The second slide, I don't know if you remember, was quality at a discount. So most of our portfolio companies are reporting quite healthy earnings. So the return on capital, the return on equity, the price earnings ratios are all actually pretty much in healthy territory. So we have not done anything dramatic to our portfolios. What we have done is three things. I think one is that we used to run very concentrated portfolios in the past. We have diversified across more sectors now compared to say 3 years back. That's also in the nature of what's happened to the Indian economy. Over the last 2 3 years, many companies have been able to repair their balance sheets. Many companies have, sort of improved their debt equity ratios. Many companies have improved their operating model. So many companies have actually come into our investment universe. So we have practically doubled our investment universe in the last 2 years. That's obviously led to more companies getting into the list, and we have been quite flexible. I mean, there are people who say, no, no, you guys invest only in MNCs or invest only in top quality. That's also true, but quality is a movement. We have now started putting some money into PSUs because many PSUs are now really become high quality PSUs, given what the government has done over the last couple of years to their industries and to their products. So I think that is the three, four things that we've done. Now coming to the important part as to when do you think this will happen? I think when does recovery happen? I think for recovery to happen, we need to see the US Fed actually start getting into pause mode. I think that's important because today a large part of our underperformance is also, frankly, due to the fact that we have a lot of stocks which are in common with stocks which FIs have brutally sold off over the last, especially over the last 18, 19 months, right? And that, so FIs, when they sell, they are basically doing portfolio rebalancing. Like, for example, the reason they've sold off in the last, our guess, the reason they've sold in the last 15, 20 days is that because of China suddenly opening up. I mean, in October, they were completely closed. People were talking about very strict COVID policy, etc., etc. And then suddenly in November they just flipped. And that China can do that because they are an autocracy. I think they don't go through the processes, the democratic processes that we go through. So they can go flip both ways. I think they can shut down, open up. And obviously, when they opened up, I think their stock markets were in a much, much more reasonable valuation compared to India. So some money got taken out of India, put there. So I think for us, a large component of our portfolio is linked with FIs because FIs are also growth and quality investors. You see across their holdings, large parts of the holdings are very similar to what we have, and we are idea generators. We have no problem. We have no market cap bias. We have no as long as the company fits into our scheme of things in terms of governance, in terms of return on equity, in terms of product, in terms of management. I think we will look at it. So I think that's the important thing, Hari, is that I think right now we need to have some more patience. I think the whole international situation from where we are standing today will look much clearer in the next 6-7 months. Most experts forecast that the Fed will stop hiking rates and go into a bit of a pause mode in the second or maybe third quarter of this year. Right? Of course, that is subject to inflation and other data points that will emerge. But what has come out in the last 3-4 months after the brutal set of rate hikes that have happened in 2022 is that their economy is slowing off a bit, and that's obviously Europe is in much worse shape. China is in bad shape. So I think you will see a bit of a pause. When that happens, I think a lot of our sector stocks will come back into limelight because they are really doing well. There is no let up in their growth. There is no let up in their plans. Uh, Management commentary is very very strong. So I think that's the good thing. Yeah, now we just have to hold on and wait for it. That's it.
Sure, thanks. I think a couple of interesting points which you also mentioned in your presentation was you talked about the slide of value versus quality, and just for the benefit of all of them, I would want to reiterate that different styles perform at different periods of time. What we have seen over the last 2.5 years, as Raghav presented, was our style has not worked. But what is interesting is if you looked at that slide, it was from a long term perspective. It is quality which always outperforms in the long term, and the outperformance is significant to the extent of almost 5% per annum. I think with the last 2.5 years, we have not been able to. Our style has not worked. I think it's just a matter of time that we quickly see that our style has come back into favor. The other thing that he also mentioned in his presentation was the fact that we had significant overweight exposure to IT as a sector, and which sort of did not perform too well. I think both of these sort of contributed, and of course, so those changes. I think that's a very important point. Raghav mentioned that we have made those changes over the last 2-3 years. There has been significant change in the way we have been diversifying in terms of adding new sectors, and the investment universe has gone up. I think that's important, and therefore those changes, as necessary, has been done. I think it's a matter of time before we quickly see our style coming back into favor. You talked about
In fact, Hari, this is ideally this is a great time to actually add further to the stocks, right?
Absolutely, yes,
In
yes.
fact, people say, should we stop our SIPs? I say, no, no, no. SIPs, the beauty of SIPs is that they allow you to, sort of not time the market. So actually, this is a great time because you're getting more units at a lower price. So actually, this is the worst time to stop your SIPs or redeem your SIPs or redeem from underperforming. I think the key thing that an investor must understand is that if a fund is underperforming for reasons uh, which are not portfolio specific, right? If the portfolio has issues, yes, then you should take a good hard look and, if required, jump off. But when you look at the portfolio and you see the companies are pretty solid, the earnings are great, there's nothing wrong with that. I think actually one needs to add more into it. The best time to invest in a value flavor was actually 2019-20, and unfortunately that was a time where you saw maximum amount of outflow from the value style because it had not performed for 2-3 years before that. So value started underperforming in 2015-16. Growth started outperforming. Uh, yeah, that's an iterative process that we all go through. But I think it's important for all of us here in this call to be disciplined and to actually allocate more when something is not doing well, not because of external situations or not because of anything internal. But if the companies are good, the earnings are great, I think that's a green flag to actually put more money.
Sure, thanks. There's a question which talks about international funds. Given the fact that we're talking of recession and slow growth in this particular calendar year, do you recommend international funds at this point in time? And if yes, what kind of fund should one look at?
I think international funds, it's to some extent, I think it's important because most of us have some offshore ambitions, right? Right. Basic stuff like just going on a holiday, more long-term stuff like getting our kids educated abroad has now become a bit of a green line. And more importantly, it provides you a lot of company diversification. Like India is a great market from a diversification perspective. We are not very commodity heavy market like maybe Brazil, or we are not a very bank stroke old economy market dominated like China, for example. So we have a mix of everything. We have services, we have software. But having said that, there are many industries which are just not listed in India at all. Like if you want to buy semiconductors, for example, they're not available here. So you should put some money abroad. I think anywhere. I'm not going to get into percentages because that's a very personal thing. I typically try and put at least 5% of my money abroad, 5 to 8%. What I have done with my funds is that I do more of global large cap because I think I'm able to capture most. I think the key thing is not to get into a country. The only exception to that in my portfolio is China because I think the key thing is that countries tend to perform up and down like stocks. So you have to give the fund manager a slightly broader mandate. So something like a global large cap fund is a great place to start. And then obviously as you get confident, things like the Nasdaq, things like innovation fund can be parts of your portfolio. Try and buy something which is not available in the Indian context. So there's no point going out and buying, let's say, global banks right now because we have a good set of banks operating in India and they will provide value to you. But let's say, yeah, if you're able to get innovation or you're able to get a fair amount of tech, uh, manufacturing tech, I think that will be interesting for you to go and look at.
Sure. There's a specific question about an investor who wants a monthly pension of about 50,000 rupees after retirement, and his or her retirement is about 10 years from now. Which scheme do you recommend, assuming that the investor is a moderate risk taker?
I think a good debt scheme, like a good long duration fund, we recently did that with one of our portfolios, where we just go and buy long dated bonds, and which give you a very good investment carry, extremely safe because most of it is all of it is in government securities, and that over a 10-year period should provide you an interesting pool of money, uh, which will compound itself on fixed income and will allow you a reasonably defined amount of money, which you can then start pulling out maybe after 11, 12 years. Also allows you taxation benefits because after 10 years of indexation, uh, practically all your withdrawals will have very low levels of tax compared to other investment instruments.
Great. Very specific question once again. This is a salaried individual, income of 25 lakhs. What is the best way to start investing? And very interesting question, how should somebody ride the share market in a volatile year?
I think I don't buy shares, Hari, you know that. So I'm a mutual fund guy. So that second question, I'm going to skip. But for the first question, I think 25 lakhs, I think importantly to first keep away about 30% of your income and save it. I think there is a 50, 20, 30 rule. And as obviously you earn more money, that 20 will become higher. 50 is what you spend, 20 is what you pay tax on, and 30 is what you actually need to save. So first get that 30% in. That's important. Number two, obviously have a goal. A goal is a good place to start. So let's say you have a goal of say retiring after 20 years. There are calculators available, including on our website. Just go there, punch in the details, and it'll tell you approximately what kind of money you will need maybe 15, 20, 30 years later and how much you need to save. In terms of risk, obviously a younger investor can take a higher level of risk because of equities. But yes, again, it's a very deeply personal question. It depends on your family background, the kind of dependents that you have, if you have any loans, things like that. So based on that, you please decide your equity and debt allocation and then invest accordingly. But the most important thing is to please start today. I think ideally the mistake that I made in my career was that I started saving much later than when I started earning. And savings are very easy to be postponed because obviously, and especially in today's world where you have sale happening every 3 days, Republic Day sale, post Republic Day sale, pre Republic Day sale, very easy. I think the world is really tempting us to spend. But remember, time is your biggest friend in an investing world, right? Time allows you to compound money. So the faster you do it, the better it is. So congratulations for asking that question, but please start maybe today's Friday, Monday morning. Please get in and put whatever money you require. On the stock side, Hari, I mean, I'm more. I think my you know, at Axis, we don't put money in stocks as an employee, but wherever I've seen investors make money, it's been people who largely invested in a set of good quality companies and let it just ride, irrespective of the stock going up and down. If you do the same thing, maybe there it's easy. But there are many people who like to trade and play momentum and do an FNO and stuff. I think the important thing there is please be careful about leverage. Leverage is a double-edged sword. It can multiply your return. It can also completely kill your capital. So be very, very careful when you're doing exotic stuff. The simpler stuff is to just pick up a good quality portfolio and just invest in it and just let it do its magic for you.
Yeah, I think from that perspective, even from a mutual fund perspective, one can look at doing SIPs, because SIPs have that inbuilt feature of taking care of those extreme volatilities. You keep buying every month, you keep adding units. I think over the period of time, you actually smoothen out the entire curve in terms of the highs and lows, and it works wonderfully well. So I think that is something that, as a young investor, as a novice investor, one should look at starting SIPs.
And do it in the beginning of the month. Please don't save SIPs for the end, because my experience is that many times money runs out towards the end of the month and then the SIP fails. So have that discipline. Spend whatever is left after saving rather than save after spending, because sometimes very little is left over.
Yeah. I think, Raghav, in the interest of time, we'll take maybe a couple of questions. The second last question that I want to pick up is a lot of questions coming on fixed income. Which fixed income scheme do you recommend in a 1 to 3 year time horizon? And if somebody wishes to stay for a slightly longer period of time, over 3 to 4 years, what is it that you would recommend?
So as I said in my talk, Hari, I think the important thing is that if you've got a 2 year horizon, try and put money into a fund that has a 2 year duration. Those details are easily available now. They're all in the public domain. You just need to do a little bit of homework or speak to your personal financial partner, and they will help you out with that detail. That's number one, first important. So anything in our case, I think our banking PSU debt fund is a good option to think about if you have a 2 to 3 year time frame, because the duration of that fund as of December 31st was about 2.5 years. It's 100% banking PSU dominated portfolio. So obviously lower levels of risk. And then yes, obviously as interest rates go up, you do lose some money on capital depreciation, but your funds are running at a much higher rate of return, right? Over a period of 2, 3, 4 years, that should do well for you. Somebody who's got a 4, 5 year investment, I think, can consider medium duration funds. I think there are funds which invest in 3 year plus kind of durations. I think they are good instruments because they're typically, at least in the access table, they are something which is a mix of AA and AAA portfolios. So they allow you some level of higher interest. And also, obviously, over a 3, 4 year period, they give you the duration advantage too. So I think that's important. But please, again, read the risk factors. I think that's important, because debt, again, is a little tricky because most people are used to straight line returns, because that's how we've been used to investing. Fixed deposits, everything else. Mutual funds, debt schemes do have price fluctuations. The price of those bonds do go up and down every day. And sometimes they go up and down quite a lot because of what's happening around us internationally, locally. The debt market is a very, very vibrant market. Fortunately, not much used by the individual investors, unlike in equity. But the same theory that happens in equity has to apply in debt too. That yes, if you see a scheme giving you a very, 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 very good return, especially in the last 1 year, I think that's a red flag actually. So you should actually get into funds which have not done too well. Have your investment horizon equal to the duration or more, so that you're able to ride out any intermediate volatility. And yes, sometimes just keep the money there with you for a long time. I think that's the beauty of mutual funds. You don't have an exit date. You may come in for 2 years, but if you don't need the money, you can keep it for 3, 4, 5, 10 years too. I've done that, and it really works very well. Yeah.
Great. I think again, as I was scrolling through, I could find a lot of questions again on access schemes, SIPs being continued. Should I continue, not continue? I think Raghav has already addressed that question. Again, for the benefit of everyone, we suggest that this is ideally a good time to sort of do a top up, given the fact that most of our schemes are at a discount. And Raghav did mention to one of the slide where we said quality at a discount. Our schemes are in a better position in terms of the relative valuation. I think it's a good time to sort of do top up, and people who continue with the SIPs and do these intermittent top ups tend to accumulate wealth much faster. I think this is a good strategy to follow in today's time. I think on that note, we should be, uh, I think, ending this presentation. I think it's almost close to about 80 odd minutes. Before we wind up, first of all, thank you, Raghav, for your
Thank you. Thank
time,
you very much.
for your presentation, and for handling the question, especially on the performance, and giving the comfort and the confidence to the investors that it's a matter of time that the cycle sort of changes, and our style of investing will once again come back, with a vengeance. Before we close, I would want to thank all the participants who have joined us on a Friday evening, and we would also request you to look at our Axis Mutual Fund mobile app for any of your investing needs. Please do download the app and use it in a digital world. I think it helps. So look forward to connecting with each one of you very soon. Thank you once again for your time, and hope it was a session which helped us to understand the philosophy of Axis Mutual Fund as a fund house, what to expect in 2023, and importantly, as investors of Axis Mutual Fund, what is it looking at, for going forward. Okay, so with that, thank you so much once again. Wish you all a very good evening, and bye-bye.
Thank you. Have a great weekend. Good day.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.